Welcome back to our final session, our final panel discussion for today. The title is Outlook and Perspectives. So we're going to end today with a few maybe peeks to the future, and the idea is to have it from different perspectives. So we have assembled this final panel with speakers from different stakeholders in this bigger debate. Let me introduce them briefly. We have on the very left, very fortunate as our moderator to welcome Kathleen Stephansen, who's the Chair Emeritus of GIC and a Senior Economist at Haber Analytics. And Kathleen is a former Chief Economist at various firms and institutions, including Hawaii and AIG. And she'll be moderating this final panel discussion. After, we have Jim Cunha here, very pleased from the central banking community, let me say. And Jim Cunha is the Executive VP and the Interim Chief Administrative Officer at the Federal Reserve Bank of Boston. Jim has asked several questions already and has a wealth of experience in market infrastructure and is also a member of the Boston Fed Executive Committee. And he basically oversees the Boston Fed's contribution towards supporting secure, reliable, and accessible US payment systems. We've heard about the Project Hamilton earlier. Next, we have Adrian Docherty from the banking industry, who is the head of bank advisory at BNP Paribas and provides key relationship to bank clients with technical sector expertise and help on strategic financial issues relating to issues like balance sheet management and efficiency, and also contributor and opinion writer on various issues of CDCC. And finally, we have Glenn Goucher, who spent almost 2 decades as part of the Canadian financial market infrastructure community, including most recently as the acting president of CDS and CDCC, responsible for clearing, settlement, depository functions for the Canadian security, derivatives, and repo markets. And currently, Glenn is an executive advisor to the first regulated digital custodian in Canada, which is Tetra Trust. So from the market infrastructure perspective, we're very happy to hear Glenn Goucher's view during that panel. We're slightly behind time, which is partly my fault because I lost track of the clock. I think 15 minutes are forgivable at this point. And without further ado, I'd like to open the final session for today.
Thank you, David. And yes, as the time, the day went by, I was reflecting on the fact that we have two major obstacles here. A lot has been said on the subject, and B, we are the last panel discussion. So, do bear with us. And we will try to fill some of the gaps, because I'm sure that there are gaps. But one of them is we don't have to answer the question of why we have digital currencies. I think that that's been talked about. One thing that surprised me is that the concept was well discussed, but the technological aspect was, we danced around that a little bit. In fact, McGill, I think it was, he said, let's leave technology aside at one point in time. So, with that in mind, I'm going to turn to Jim and ask him if he could actually zero in on the technology without losing us all, but just to give us a sense of what the challenges are. So, Jim, it's all yours.
Thank you. And so let me prove to my wife that I'm here. LinkedIn likes pictures.
Let me say one thing, and that is that one of the key issues of the digital currency is trust. Now you have to reconcile those two things. Go ahead, Jim.
Yes, I'll talk a little bit about how first of all, I'm a technology and payments guy. I'm not an economist or a lawyer. And I have to say, first of all, I've been to a couple of conferences that tried to blend economic style conference with regular industry panels. And I think this is probably the best I've seen. I think he did a good job of bringing it together and making it accessible, to all. The math in the first paper, I didn't quite get a lot of it. The dialogue was approachable. So I'll talk a little bit about, Dal did a good setup talking about Project Hamilton. But that's a technology research project that we have at the Boston Fed working with MIT. And MIT is a group called the Digital Currency Initiative. They've been applied studying digital currencies for about 6 years now. So we partnered with them specifically because we didn't want to think about technology in the old way. We didn't want to, as we say in Boston, pave cow paths. When you pave a cow path, you get Boston roads. So we wanted to think differently about the technology. And we specifically went to MIT for that. And then I hired all my technology people from outside. So they all came from the crypto world to help us think differently about what a digital currency might look like. So we went into this, now talk a little bit about the approach, which gets into challenges, into this technology agnostic, so we didn't want to build it like an old-fashioned payment system, which is, they work great, but we want to think differently about it. We didn't go in thinking no blockchain or blockchain. And so we actually started fresh, but we knew we were going to look to more leading edge technologies, because what happens with digital currency, it's really hard to make something go very fast. That's a technology challenge. To be replicated in a way that the money would never go down, you wouldn't lose any of it. So that's hard enough in itself. But when you do that and it's money, it makes it that much more challenging. If my Amazon order is duplicated or lost, it's inconvenience. But if I start losing money or there's extra money or it's duplicated, that's a challenge. So what we did is we tried to look at the technology questions in a way that we could actually create a platform at scale in the US. And that's really hard. Or in Boston, we say that's wicked hard. So part of it is building the core application to store and move the money, which is what we did with Project Hamilton. And I think the other challenge is, and some were alluded to, really get into the policy choices. And we can talk more about this later, but one that was raised, I think, as part of the most challenging is privacy versus compliance. How do you think about that from a technological perspective? And what we're trying to do is look at new technologies to maybe think about ways of thinking about policy, different policy outcomes, because if you go based on what happens today, what happens is you'll go to banks will have to do it, they hate it, and nothing will change. But if you think about technology, could we actually maximize privacy and still catch the bad guys? We can talk more in depth about that, but we do think there's ways of doing that, not yet at scale, but maybe, for future, technology down the road, make something that could work. So I'll just stop there.
Okay, well, thank you. That was quick. You did tell me that you would be speaking for at least 12 minutes, so
Oh, okay.
we'll come back.
What? I can go back, and I'm more to Project Hamilton if you'd like. If that's how you want to, I apologize.
Yeah, no, absolutely. But let's ask Glenn first. There's been a lot of discussions on, the transmission of policy, and, someone who has spent her career really focusing on the business cycle, it's very interesting to see a new technology that could really make a payment system more efficient. But Glenn, could you just share your thoughts with regard to what do you think the financial intermediation will become in this aspect? We heard about it a little bit.
Yep.
And more importantly, from my perspective, so in a very selfish way, I would like to ask you also, do you think that this will lead to challenge really the notion that central banks are independent?
Well, the good news is I'm not regulated by a central bank anymore, so I can give my opinions freely once again.
You never know.
Yes, there are aspirations to become regulated again. So we'll go back to my and where I was going to go, and I'll talk about the role of central bank in the future. So I have a traditional background of clearing and settlement, spent a fair bit of time, and people have already mentioned that, for a long time now, we've already had things like tokenization in our payment system. That's the way the systems work, and it probably wasn't well understood, but major clearing and settlement systems always had tokenization inside. That's how they work on a daily basis. That's how you keep track of everything, and at the end of the day, it's how you settle everything. So the idea of tokenization from a settlements perspective and from an asset settlement perspective, not new. I think with the new things that are coming on, and now I'll go to where I'm spending most of my time now consulting and advising on, is in the DeFi world, and how to achieve the types of activity that are going on in centralized marketplaces today and centralized clearing and settlement, and how do you do that in the DeFi world, and do you need CBDC for that. And so the big challenge is a lot of the work that is being done or that is done on a daily basis inside of a central clearinghouse or something else is around credit and credit intermediation and how we look after making sure that payments are made. Now we move into a world of DeFi where we want to go into a trustless environment. We don't want to have credit rings. We don't want to have to measure credit exposures, but we want to have the same scale and level of activity. I don't know if we can do that today, but I think that that's the thought work that is going on as we're building DeFi systems to replicate and perhaps usurp some of the activity that's going on in traditional marketplaces and central clearing and settlement today. So the technology is evolving from a real-time gross perspective where we can have settlements. And I'll talk about settlement tokens because I don't like talking about payment systems because that does get you, I don't know who asked the question earlier. Canada, when you become a payment service provider or you're doing some sort of payments, you do find yourself in a regulated world. So I'll just talk about settlement tokens for now and the need for some form of settlement token to avoid the idea of payments themselves. And this is where I think the really interesting part of DeFi is if we're not talking about payments, we're talking about settlements. So we're talking about settlements and exchanging value and how that value is recognized and created. Let's say that doesn't matter. Technology does, I'll say. So can you create a system that's trustless, that has multiple chains, without APIs? And so this is the challenges that are thrown at technology. And I would say yes. I would say clearly we have something now that is called an atomic swap that sits on a layer 2, getting a big nod over in the corner, because this is the direction that settlement systems on a gross basis will likely go. It's the direction that we're exploring right now, where we can have multi-custodian, multi-chain, multi-participants in a regulated environment using atomic swap to get real-time gross settlement without risk. So that happens. In that world, do you need a central bank? Do you need a central bank to the currency? And if they're not going to be available till the end of this century, I'm saying no, because we're working a bit faster than that, where we're coming from. And I do think that this world of DeFi and FinTech, however you want to mix them up, is going to push that boundary.
Ooh, that makes me somewhat uncomfortable to imagine a world without a central bank. But that brings me to you, Adrian. You are a big proponent of this private-public arena. What Glenn is suggesting is essentially a private arena. What are your thoughts of that? Getting rid of the public arena, essentially.
Not in this audience, I wouldn't say that. I do find myself talking on this topic mostly in front of anarchists and people who want to dismantle the whole system. So it's rather refreshing being amongst people who only mildly want to modify it. Just right. Yeah, the topic is really, isn't it, about public versus private? And was it Ronald Reagan who said, the 9 most dangerous, worrying words to hear are, "I'm from the government and I'm here to help." So, I work for a commercial bank. I am TradFi. I'm going to be quite defensive today just to balance things up. But I think the banking sector, as is pretty good. And I'd rather that people weren't remunerated on their deposits at Fed funds rates and that banks took some profit out of that business for all the services they provide on the back of that. By the way, for the last 6 years, banks in Europe have been providing deposit rates of 0, which is 50 basis points more than the ECB deposit rate. So, they should be congratulated for that. But no, public versus private. So do we want the central bank to take on certain activities which currently today reside within the private sector commercial banking industry? I would say no. I would rather the central bank focused on its what I view as its core activity of providing monetary stability, and someone said it earlier, social welfare and so on. I don't think there's a use case for central bank current accounts, which we're calling CBDC, but CBDC is a throwaway acronym. I think a lot of the discussion today was around government-provided banking accounts. Now, should you entrust everything to the private sector? I thought there was excellent data earlier about, the private sector needs to up its game. In some aspects, it behaves as an oligopoly. I don't know if it's safe to say that in Canada, but taken as read. My country, they call it an oligopoly sometimes, and I don't believe it is. But anyway, it has sometimes those features. I must say, in some of the markets in Europe, banking is a terrible industry and hardly profitable at all. You look at Germany, you look at Italy, banks are actually lent on so much that they are not viable commercial entities. It's awful, right? So, I wouldn't, I really wouldn't look upon the banking sector as an evil, incompetent sector that needs to be punished and have its profitable business taken away from it. But I do, take on board it needs to up its game. And a lot of the discussions here today, time expiring deposit balances, these are positive things which the banks should be doing. We shouldn't rely on central banks to catalyze those activities. They should come out of the private, competitive, Reaganite banking sector.
Wow, it's been a long time since someone referred to Reagan, but anyways, it's an interesting point that you're making, because at the end of the day, who is the driver of innovation? And it seems to me that the competitiveness between the private and the public sector tends to give that. And earlier, we heard about the regulatory aspect and innovation. I mean, regulation is lagging so much, given the fact that technological change is happening so quickly. And again, back to you, Jim, tell us a little bit about, this Hamilton project and to see where we stand in terms of, how the momentum is.
Yeah, and I apologize. I have 3 speeches this week, and in my mind, I was going on a different agenda.
Not to worry.
I will say one thing about regulation. The US is 40th with a faster payment system, only because we don't regulate. Every other jurisdiction, starting with the UK, regulated their payments, their faster payment scheme into being, and we're last because we didn't. So sometimes regulation is an enabler because it actually forces some, I think, positive things for competition in the UK, et cetera. And in this case, we're lagging, but we'll get there. So let me talk a little bit more about this Project Hamilton. If we have time, I'll tell you where the name came from. It's kind of cute. But first of all, the motivation, you can debate whether it's a good or bad thing. In 2019, China was announcing their, near public pilot. We had Libra, we had JPM coins, stable coins were starting to take off. So, our motivation at first was just to understand the technology and to build something in case we needed to. And then in March of 2020, as part of our COVID relief bill, there were 2 bills that weren't passed that would have forced the Fed to build a digital currency and make payments for COVID relief directly to citizens. And they would have given us 9 months to do it, to build it. And so there's a motivation to be ready because it's a blunt instrument called a law that can sometimes force you to do something. So to Darryl's point, we should be ready. One, if we want to lead from a technological perspective, but in case we're told that you have to do this. So that's a reason why we should be ready. Otherwise, we're 3 years behind them. But what we did is we built a core engine for storing, minting, and moving the money. So think of it just like Bitcoin as far as how it works. And our goal was 100,000 transactions per second. So we wanted to build it at scale, 100,000 transactions per second, some level of security, and then resiliency. And so we actually built 2 engines, and our paper is published in February of this year, which you can look at. And one of those engines goes 170,000 transactions per second with finality under 3 seconds. The other one does 2.2 million transactions per second with finality under 1 second, because we're using leading edge technology. So if the technology question, we actually build something that kind of looks like blockchain, but leaves all the stuff you don't need. And the structure of the money is, if you understand Bitcoin, it's actually is unspent tokens, UTXO. So it's not an account model. It's not really a bearer instrument. And that's where terminology gets, it's not account versus, token, because those are not always well-defined. We built something that basically looks like Bitcoin. There's hunks of money stored in a ledger that we would run that is replicated all over the US. And we've taken down multiple data centers and still run full speed with all the data intact. So we built something over 100,000 transactions per second, settlement under 3 seconds, and with resiliency. Because that's table stakes. If you can't do that, you shouldn't be trying to build a CBDC if you're operating at 50 transactions a second. It's just you haven't done enough to even be at the table. So where we're going next is we're starting to think about, first of all, we've coded in how do you audit the money to make sure none's been lost, stolen, or replicated. So a constant audit of the money, which is important. And we're also looking at programmability. People have talked about programmability with money. I don't believe in smart money. My money shouldn't stop me from having that 4th glass of wine. It shouldn't stop me from doing anything bad. But is there a level of programmability that should be in the money? And everything else can be outside and other levels and wallets and stuff like that. So maybe for atomic swaps is something that should be embedded in the money. So we're doing experimentation, and some of the structure of the architecture makes programmability harder. And so we're trying to understand, based on the 2 architectures we built, one makes it really hard to do programmability, the other is very easy. I get more into that, but it's in our papers. So every decision you make affects other decisions you're trying to make. The next area we're going, and this may be with some other central banks, is with privacy, because that's probably the hardest nut to crack. And then privacy, as I said before, versus compliance. Banks hate compliance, it's expensive, so I'll help you out. Is there a way for a different way of thinking about compliance? I'm not a policy guy, don't read policy into this, I'm a technology guy. But can we use something like a zero knowledge proof at scale, examine the data, kick out the bad guys, and let everything else pass through? And nobody looks at it except maybe the intermediary, which was a bank that originally got the transaction. So what we're trying to do is see if we can make different policy options available by new technology, because the policy decisions haven't been made. So in a nutshell, that's where we are. As far as forward-looking, we know privacy and compliance, but because of the executive order, because the board of governors in the US have done a consultation they're looking at, because of many other things that are going on, we're not quite sure where we're going next. We're definitely going forward, but it's just in what direction, at what speed. If you listen to any of the governors, it's not a surprise that governors are disagreeing with each other on where to go. You have Lael that wants to go more in the Christine Lagarde camp. You've got Chris Waller, who thinks we should do some research, but we're doing enough. No more than that. So, we're trying to work through that. That's not inside baseball. That's just very public. So, we're trying to understand what the future needs are and where we go with it. I'll leave it at that.
And the source of the name?
Okay, all right. So obviously it's a nod to Alexander Hamilton to get the grandfather of the central bank. But so my team, we're working with MIT. We started calling this a moonshot because I built a startup company inside the Fed. And this is a moonshot, right? If we built a CBDC, it's a moonshot. So my team actually did some research, and it's also named for Margaret Hamilton. So Margaret was in charge of a research lab, a technology research lab at MIT in the 60s. And her group designed the guidance system for the Apollo space program. So it's a nod to Margaret Hamilton as well.
Which is really nice. Not many women get recognition, like that, particularly also. I always remember Joan Robinson. She never got the Nobel Prize, and she should have, seems to me. Anyways, that's off subject, sorry.
Let's debate that, come on.
Let's debate that. So, Adrian, what do you think the central bank would be capable of? How would it be capable of conducting monetary policy if, let's say, we had a CDCC?
Well, as you know, I start from the premise that we already have a CBDC in the wholesale sector. Central bank reserves are transmitted digitally, have been for 20 or 30 years. So I think monetary policy at that level would be very similar. The monetary transmission through to retail, I think it would be negative. It would be bad. So I think by creating a 2-tier deposit system where you actively degrade commercial bank deposits, you would create liquidity risk. Pre-stress, you would create credit allocation, capital allocation risk, where the state has increasing control over which sectors. And I think in today's environment, you would probably end up putting much more capital towards politically acceptable investments like green. Now that might be a good thing, but that's subsidised public funds going into credit, which is a new development. The problem with monetary policies, I think we all need to pause and rewrite the textbook, because I'm from the UK. We've had a turbulent couple of days.
Yeah, I wanted to ask you about that.
Yeah, I'm glad to be in Canada. Well, yeah, I'm not spending any money. No, I think the ECB has a project for the digital euro into retail. My view, personal view, which is not dissimilar to the BNP House view, is that we do not need a retail digital euro. We have excellent bank accounts, we have excellent payment services within the Eurozone, cross-border, instant, cheap, etc. And that the problem of the unbanked, A, isn't such a big problem, and B, won't be solved by a retail CBDC. The ECB nonetheless is progressing, and its current fix for the liquidity and the monetary problem is to limit holdings to 3,000 euros per capita. Why 3,000? Because that's the average monthly wage. It roughly corresponds to paper cash holdings in Eurozone today as well. I think that's early days, and that thinking still progresses. So not a very clear answer, but I think it's a very difficult question.
It's interesting because there was I think a few months ago, the Deutsche Bank had done a survey on, what the perception was for people, whether they prefer cash or crypto. So this is not the central bank digital currency. And surprisingly so, even in China, apparently cash was still, what people preferred. So we're still at the very, very beginning, I guess, of the general acceptance of this concept.
Of digital money?
Yeah.
Oh, but in Europe, in many countries, paper cash has more or less disappeared.
But the preference from this survey seems to indicate that cash is still what people prefer. So there you go, But it's, it's Deutsche Bank, it's a competitor.
Yeah, they're not.
But pushing the argument a little further, Glenn, what do you worry that this could become a political, and we've touched on that in the other session, but a political situation or problem?
So to be clear and clarify my last statement, I think we need central bank digital cash in general. And I would also just comment on the last question that, the monetary policy question is much more important in times of crisis than it is during normal times. And all of this conversation came up during crisis and not during normal times. So I think there's probably value there as you think about it. When we talk about the geopolitics of money and what's happening today, I do have concerns. I do have, and people have touched on it already today, about cross-border transactions. Obviously, a lot easier in the digital realm and crypto realm, with stable coins and everything else like that, to move value cross borders in real time. I don't know how, and I'm in the regulated world. So even though I'd say that I'm in the disruptive world, I'm in the regulated disruptive world. So I have to acknowledge, for that world to be successful, you cannot have unstable payment mechanisms underneath the systems. And so anything that is done that creates an opportunity for disruption on a national basis means that national infrastructure won't work, can't work. Right? So yeah, I think about it. Don't know if I'm losing any sleep about it, because it's not my day job.
And do you think that the transition from this, the cryptocurrencies now being really an asset class as opposed to a means of payment, the transition to becoming a means of payment as such? Do you think that that's around the corner?
So I think this, what's amazing about today for me has been the evolution of not talking about Bitcoin as a currency or a payment mechanism. And the evolution that we've had, either the maturity or the evolution we've had in our thinking, that it's not just about the blockchain, because we recognize now that blockchain, as beautiful and as elegant as it is from a technology perspective, is not the only, it's not the only solution. We also, you recognize that Bitcoin itself, not a very practical payment mechanism. Although there's some pizza that was bought a long time ago, that most expensive pizza in history now, and so we can use it. And I talk about settlement and exchange of value instead of payments on purpose, because the really interesting opportunity, I think, is when we talk about digitizing real assets, real estate, bonds, securities, hurricane insurance, anything else, is that we can exchange things of perceived value with or without currencies. And it will be really interesting to see the evolution as that happens on whether or not you need that intermediated solution of currency, or else you're just exchanging values. But that's going to happen at some point.
What are your thoughts about that, sitting at the central bank?
Question? This way, but no.
Oh, I'm sorry. About the fact that, at this point in time.
I was a little facetious. Sorry. First of all, I agree that I think cryptocurrencies they're not used for payments. I can't imagine someone would hold it while it's at 80,000 going down to 20,000 and hope to buy something with it. I think stable coins have more potential, more on the wholesale side than retail. I'm not sure what the retail play is there. It's an awful. I think a cost and shift, and it's not regulated yet. And once it's regulated, it'll be a whole different product and market than it is today. So I see more on the wholesale side as a potential. But once it gets systemically important, it's going to be regulated at that market. So, but if you look at something like a Finality, which is stablecoin created by 12, 14 of the largest securities banks in the world, there's real promise there with delivery versus payment of securities, where you've got money on chain for atomic swaps. I mean, there's a real ROI for that. But I just don't see, the same, flow into the payments business. I see more as a store of value in the retail side of anything. I mean, Venezuela, good, if I can buy it, great, I'll get a hedge on inflation, but I just don't see a quick course in. We talk about the adoption. Everything takes 10 years to get adopted once it's even in market and good. So I don't see anything, even the stable coin, going too fast, except in some of the larger, more industry-focused activities like that.
And before we open it up to questions from the audience, Adrian, I want to ask you, what are your thoughts about a CBCD environment in relation to sanctions?
I've got an example here actually, because I've got a friend who's at De Beers, and they have just launched. So De Beers, the diamond, the world's big diamond monopoly, provider. They have just implemented a blockchain-based tracking system for diamonds, and I've no idea how it works, but he seems very pleased with it, and they've spent a lot of money on it. And he said it's really helping them now with sanctions against Russia, because diamonds can be used to launder to move money around, to move value around. So I think that is a really clear example of where new technologies can enable you to do things with old technology are very difficult. As far as banks are concerned, I think it creates currently the payments leg creates more risks than opportunities. I worry the hell out of anonymous transactions, and it's been mentioned a couple of times today, the whole privacy angle and the privacy debate and trade-off. And it is extremely concerning when currencies or tokens or digital currencies, things move around without audit trail and without necessarily having clear identification. We spend a lot of money. Some of the banks, it's like 5-10% of their workforce is working on KYC, AML, ATF. There have been some horrendous mistakes, and it's really, really difficult, especially with complex corporate structures and so on. So any new technology, any new approach to that brings with it difficulties. I'm sure we'll solve those difficulties, but they are there.
Over time, that is, yeah. So we have about 5 minutes, and please, if you have any questions, yes, sir.
I have a question for Adrian. I think because we have a practitioner here, it's great to sort of test some of the academic thoughts that were presented today. So you're at a large bank. Do you predict that the introduction of CBDC, let's say European Union introduces it tomorrow, would you expect it to increase the cost of funding, and would you expect that to affect the lending decisions of the bank, or do you think that the BNP Paribas is relatively immune to this?
Well, obviously, BNP Paribas is very strong and stable, and look, I think it's a competing investment or a deposit, as deposit class for the retail customer, who probably today doesn't, recognize the difference between M0, M1. They recognize what a government guarantee is because they were taught that 12 years ago. Let's say a CBDC is introduced and it's capped at €3,000. That's the current proposal on the table in the Eurozone. I think that most people will be confused as to why they would want to put €3,000 in this separate account or separate, bucket, and the rest of their money is, BNP Paribas dollars or BNP Paribas euros rather. So it'd be a bit confusing. If there was a scare story in the newspapers or something bad happened, you could imagine people trying to, top up their 3,000, use other people's 3,000. There was quite a lot of that happened with the deposit guarantee. People, shopped around and made sure they knew how they could max out their cap. So that could create a sluice of liquidity risk. The study this morning from loan and lending volumes and so on, I really don't know. So if everyone in a bank withdraws €3,000 equivalent and stashes it with the government, I don't know what the government's going to do with that. Does that then just, sit on the central bank balance sheet, and therefore it's just sucking liquidity out of the system? Or is it available in a sort of, collateralized lending mechanism back to the banking system, as we've had with things like LTROs and so on? So is it a case of it gets siphoned out in order to be siphoned back, and somehow there's added value in that process? If, as the study assumed, banks actually don't have access to that and have to raise money on the wholesale funding markets, I think that's a disaster. Aren't we trying to make banks more liquid, more solvent, more stable? Whatever the remuneration rate, which is a negative spread in Europe, whatever the remuneration rate, retail deposits are an excellent way of funding a credit system, right? And I think banks do a good job, and banks can do better. But if we actually turn banks into lending machines without a deposit base, in the extreme example, well, we've seen a few disasters happening there. Wholesale markets close, bank just fails. Northern Rock Bank had 2 weeks liquidity. You could force banks to term fund. In fact, in my book, one of my proposals was banks should be term funded. Zero maturity mismatch. And that would be an interesting experiment to see then where the actual value and the risk is in banking. Because I'll tell you what, if you're lending 5-year, 10-year money, if you're funding yourself overnight, you could make a nice little profit by the maturity mismatch. If you have to fund at 5 years, you'll probably find you're not actually creating that much money through the deposit loan arbitrage. So yeah, I don't know. I'm not a macroeconomist. If someone said 30% of your deposit base just left the bank, how are you going to lend? I'd say, well, we're going to have to borrow more money, and we're going to be in the markets, and that's going to cost, and it's going to make us less stable.
There was another question over there. Yes.
So there was this question about atomic swaps, cross-chain interoperability with blockchain. So in August, hundreds of millions of dollars were stolen from bridges in DeFi. Does this create a new source of systemic risk, and how are we going to address this? And if a big bridge gets hacked, then will they fry everybody for the government, or what are your thoughts on that?
So since I was the one that introduced the atomic swap, it's a great innovation. So the tech bridges, I'm not the technologist, but my understanding is a bridge is not the exact same as an atomic swap from a risk perspective from a technology. Regardless, the idea that there is at risk, the idea of anything being systemically risky in the short term, I would say absolutely not a chance. We've watched a crypto asset market go from 3 trillion in market cap to 1 trillion, and I don't think it affected anybody's life other than the people that happen to own those crypto assets. Systemically important as a term, I made the mistake, Paul's not here now, but when I was running Clearinghouse, one of them wasn't designated systemically important at the time, and I made the mistake of asking the bank to regulate us as being systemically important. That comes with an awful lot of oversight and a burden of your ability to meet the needs of the entire marketplace that none of the systems we're talking about today in the DeFi will achieve in a reasonable amount of time before there's changes to it. What I'm really excited about from the DeFi and atomic swaps and the ability to exchange value and assets is moving forward with this project, if they were going to call it a project. Hamilton is a project, and I think DeFi is a project as well. Sadly, funded with assets today that are worth less, but a project that says, how do we recognize? I was at the Tour de Beauce for a year, and I had 1%ers camping in my front yard for a year because of the trust issues in the system. And I think the work that's going on in DeFi today is pushing us into a better trust environment for all of us, but it's going to come with some bumps and bruises and pain points along the way as we work our way through it.
And I'll also add that most of those that where the money's stolen from is an unregulated entity, so you don't have the regulation. And if the central bank, if you look at finality, that's going to be a regulated entity, and I think you'll be able to hopefully counter some of those vulnerabilities in those systems. It's not a talk of the atomic swap or not, or the obviously the middleman or the exchange is where some risk is, but I assume it'd be regulated if it was systemically important.
Yep.
So Kathleen, you had a question. Perhaps we can make this the last question. Yeah.
Yeah, okay, so my question is, like you all mentioned the importance of privacy, but I would want to ask you to be a bit more concrete about the potential approach, because if we are thinking of a retail individual, who could use cash, but nobody uses cash anymore, and taking money out of ATM is probably a big security risk compared to many other needs. So there are two possibilities. Should we trust banks on that, or should there be a retail CBDC offering people this privacy services, or there is a third solution that would protect the privacy of individual?
I guess I'll start by, privacy of what from whom. You have to define it.
Yeah, so here
Like I don't say fully anonymous. I would never say fully anonymous. That's why people say tokens. I think they're anonymous. But today the Federal Reserve runs payment systems, and we have a lot of data about what you spend that goes through not debit and credit, but ACH checks. We see the check you wrote your mother and how much it was for. We have an image of it. So there is a ton of data inside the Fed, and none of it is ever leaked. If there's a court order, it gets out there. We don't care who wrote what to whom, except for economics perspectives. We look at it at macro. So I think there's an N of many right there where the quote unquote government has a lot of data about people that we do nothing with because it has no value and legally we can't do anything about it. So I think that's just one way that people think CBDC is going to be how China's approaching it. It's going to be the government has everything. They can now tax me on all this. I would just say that's not necessarily the case. So I think privacy for us is, how do you minimize the information outside of the two parties as far as who sees it and who has to see it, and if a bank has to consider an intermediary where they see it today. So you can make it look like today, and I don't think that's too bad. But if you want to improve privacy, then I think you have to look at new technologies and new approaches. I just leave it like that.
I'll say from a today's banking point of view, there's two types of privacy. One is criminal activity, which deserves zero privacy, and we need to employ people to hunt those activities down, even if it's difficult, and ensure our systems are helping us in that. And the other is the privacy of our own citizens, which should be respected. And the middle ground is me paying a builder in cash, so he or she doesn't have to pay income tax, right? So what do we do there? That's the really difficult one, because it's it's a little white lie, and I don't. Water flows downhill. So whatever system we invent, there will be grey zones where slightly illicit but not terribly bad criminal acts occur. And these are the ones that we need to stop, be it terrorism, sanction busting, whatever. And I hope that a modern system will actually make it easier. So, there was a problem in France with prepaid debit cards. They were a big thing, and people were buying big bricks of them, 200 euros per card, and they were changing hands in, shady corners of car parks. The burner phone issue, that's an issue for telcos and corner shops selling the SIM cards. Those are the things that I think the real battleground will be on. But I'm hoping that more powerful systems will help us with the really important things, with millions and billions of dollars and euros going to bad people.
Well, there are many other questions, I'm sure I have at least, but I guess that it's time to say thank you.